Why are adjusting entries even needed? Why can't businesses just record transactions and move on? It seems like that would be enough. After all, once transactions are recorded, shouldn't everything already be complete? Not always. Timing matters in accounting because money doesn't always move at the same time that revenues are earned or expenses are incurred. Businesses may pay for something in advance, or they may provide services before collecting cash. Because of these timing differences, some accounts need to be updated before financial statements are prepared. Those updates are called adjusting entries. By the end of this lesson, you'll understand why adjusting entries matter, what they are, and how they work. But first, let's understand the problem that adjusting entries solve. Cash timing and accounting timing are not always the same. Just because money is received or paid doesn't mean that's when revenue or expense should be recognized. For example, a business may pay rent for 6 months today, or it might provide a service now and receive the payment next month. If accounting followed cash alone, profits could become misleading because revenues and expenses would be recorded in the wrong periods. That's why accounting focuses on economic activity rather than simply cash movement. Adjusting entries helps solve this timing problem. There are two common ways to record transactions. The first is the cash basis. Under this approach, the focus is the movement in cash. If cash comes in, revenue is recorded. And if cash goes out, an expense is recorded. And this is a simpler way to record transactions between the two approaches. The second approach is the accrual basis. Under the accrual basis, the focus is on economic activity, meaning revenue is recorded when it's earned, and expense is recorded when it's incurred, even if cash hasn't moved yet. This approach is more accurate than the cash basis. Financial accounting uses the accrual basis because it provides a more accurate picture of the business performance. And because financial accounting uses accrual accounting, adjusting entries become necessary. Let's test this idea with a simple example. Suppose a company paid $12,000 insurance for 1 year. Using accrual accounting, at the end of first month, should the entire $12,000 be recorded as an expense? Take a moment and think about it. The correct answer is B. No. The entire $12,000 shouldn't be recorded as an expense. Even though the company paid the full amount upfront, only 1 month of insurance has been used so far. The remaining coverage still provides future benefits to the business. This shows us an important idea in accounting. Just because cash was paid doesn't automatically mean the entire amount should become an expense immediately. So if we can't simply rely on cash payments, how do we make sure our accounts are accurate? That's where adjusting entries come in. So what are adjusting entries? Adjusting entries are made at the end of an accounting period to ensure that revenues and expenses are recorded in the correct period. Their purpose is to update account balances before financial statements are prepared. Without adjusting entries, some revenues may be missing, so we need to recognize revenue in the correct accounting period. Additionally, some expenses may be recorded incorrectly, so we need to recognize expense properly by adjusting them. Adjusting entries ensure that both revenues and expenses are recognized in the period in which they actually occur. Think of adjusting entries as the final updates that help ensure the accounting records are complete and accurate. Now that we know what adjusting entries are, let's see where they fit into the accounting cycle. Adjusting entries are recorded after the trial balance has been prepared and before the adjusted trial balance is created. Let's look at the accounting cycle again. First, a business transaction occurs. Next, that transaction is recorded in the journal. Then, the journal entries are posted to the ledger. After posting, a trial balance is prepared to check that total debits equal total credits. At this point, some revenues or expenses may still need to be recognized because of timing differences. And that's when adjusting entries are made. Once the adjustments have been recorded, we're ready to prepare the adjusted trial balance and continue with the next steps in the accounting cycle. So adjusting entries act as a bridge between the trial balance and the adjusted trial balance. Let's summarize today's lesson with the rule behind adjusting entries. Under accrual accounting, revenue is recorded when it's earned, and expense is recorded when it's incurred. Notice that the rule doesn't say that revenue is recorded when cash is received or that expense is recorded when cash is paid. That's because accounting focuses on economic activity rather than the movement of cash. Throughout this lesson, we've seen that cash movement and economic activity don't always happen at the same time. That's why adjusting entries are necessary. They help ensure that revenues and expenses are recognized in the correct accounting period so that financial statements present a more accurate picture of business performance. If there's one idea to remember from today's lesson, it's this. Adjusting entries exist because accounting follows the accrual basis of accounting. Now let's see if you can apply that idea with one final challenge. A company paid $12,000 for 1 year of insurance. Using accrual accounting, how much insurance expense should be recognized after the first month? Is it $12,000, $6,000, $1,000, or $0? Think about the concepts we discussed today before answering. Remember, under accrual accounting, expenses are recognized when they are incurred, not simply when cash is paid. Leave your answer in the comments below. You can also comment "got it" if everything makes sense, or still confused if you'd like more examples. In the next lesson, we'll look at the 4 types of adjusting entries.